Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, welcome to this podcast. I am Shaily Gang, Chief Investment Strategist at Standard Chartered Bank. And today we will talk about India fixed income market with our esteemed guest. He is someone who executes his view on the Indian fixed income market across the India yield curve, across maturities, whether short-end or medium to long-end or the very long-end maturities. And also he executes views across various instrument segments, whether you talk of money market instruments or corporate bonds, government securities or SDLs, the state development securities. So I welcome Mr. Anupam Joshi, co-head fixed income at HDFC Mutual Fund. Welcome, Anupam.
Hi, Shaily.
Hi, glad to be talking to you, and I'm very excited to do this podcast with you and try and derive a sharp fixed income view for our investors.
Sure.
So, to start with, what is your view about or your thoughts on the inflation growth balance that RBI is wanting to achieve, and more so in the background of the RBI monetary policy that we just saw yesterday with the August monetary policy?
Yeah, so in this backdrop, yesterday's monetary policy to our mind was quite dovish in terms of the undercurrent or the undertone that RBI adopted. More so on these lines and in line with what generally a central banker would want, the ideal policy setting backdrop that monetary policy had yesterday. They revised their inflation forecast down by 10 basis points from 5.1 to 5% for the full year target. At the same time, they have revised up their GDP growth forecast by 10 basis points to 6.7% for the full year 26-27. So in this construct, this was the best outcome that the monetary policy could achieve. In an ideal world, what RBI would want is that they would want an inflation to be at or below the target, and they would want growth at or above the potential growth rate. So in this construct, using the argument of a lot of supply-driven shocks creating and leading to inflation above the target, and the same shocks leading to a potential GDP outcome below the potential growth means that monetary policy continues to remain accommodative at current juncture. More so, they also mentioned that the core inflation or the core inflation still continues to print very close to their target, and that gives them the additional comfort that they can choose to overlook the supply related disruptions on the inflation at current juncture and continue to remain monetary policy accommodative to promote growth in the coming quarters.
True. So we understand the bar for RBI from the rate hike perspective is high because the core inflation seems to be quite steady. Anupam, one more thing is that, in the natural progression of things, when do you think, or what is the timeline in your mind on the rate hike happening in the natural way? Meaning that let's assume that crude oil prices are lower and inflation is under control. But as the consumption recovery happens and the growth comes by, the inflation would come by naturally. So in that scenario, when is a rate hike possible? Is it possible in FY27?
So it's not about the timing of the rate hikes. We expect that rate hike can happen maybe over next 6 to 9 months. The quantum of rate hikes and the pace of rate hike is what will matter to the market. At current juncture, if you were to look at bond markets are already pricing in 3 or more rate hikes from the RBI over next 9 to 12 months. Which means that RBI is most likely to deliver at least 3 to 4 rate hikes in this fiscal year. Our sense is that it's going to be 2 to 3, taking your repo rate of close to 575 to 6 by end of this cycle, possibly over next 9 to 12 months, which is what we would expect. But that, something is bond markets have already priced in at current juncture.
Okay, interesting. So from talking ahead, taking this further, the discussion towards liquidity and the short end of the yield curve. Now, with the RBI liquidity situation improving and seeming comfortable because of the various RBI measures on capital inflows, and because of that, the demand-supply dynamics of bonds also looks to be relatively better. So, from that perspective, over the next 6 months, what is your expectation of the fall in the short end yields, let's say from 1 to 5 years maturity bucket?
So in response to the improving liquidity, we have already seen that the extreme short end of the curve has reacted very, very positively over last couple of weeks. As system liquidity has improved from almost neutral to almost 3.5 lakh crores surplus as of yesterday, we have seen that the short end of the curve has already responded. We think that the quantum of inflows that we are going to get under the FCNR, ECB and the various other measures that RBI announced in the June policy will determine the quantum of absolute liquidity that system will witness going forward. Our base case assumption was that close to $60 to $80 billion of inflows should come through between June to September, which could have led to your system liquidity temporarily spike in excess of 5 to 6 lakh crores of headline or core liquidity by end of September. But in line with the currency leakages, what would have developed over a period of year between now and March, along with the forward dollar maturities of RBI, and if they choose not to roll over these forward maturities, we would come back somewhere close to neutral to marginally positive liquidity surplus conditions by end of March, if the assumption is that the inflows are anywhere between $60 to $80 billion. In this construct, when markets will get a very large comfort on the visibility of liquidity availability over next 2 or 3 quarters, there is a very large potential for your front end of the curve to adjust lower even further from the levels where we are at. Because in this construct, even if RBI hikes interest rates by 1 or 2 more times over next 6 months, your operative rate does not meaningfully change, which means that at 5 quarter on repo rate with a tight liquidity conditions, the overnight or the operative rate was somewhere between 5 quarter to 5.5 for major part of the previous quarter. Even with 2 rate hikes but with surplus liquidity, your operative rate even at 5.75 on repo rate can continue to remain between 5 quarter to 5.5. Because your operative rate will start operating at the lower bound of the corridor for next 6 months. So in this construct, we can build a case where shorter end of the curve or the front end of the curve, especially 1 to 3 year parts of the curve, can continue to well anchored or continue to ease gradually over next couple of quarters.
Thanks for that, Anupam. Now, once we are past the benefits of these RBI measures, and you as an AMC have, I think, talked about the weaker demand side of bonds because of the widening gap between the credit and deposit credit growth and the deposit growth. Now, once we are past the benefits from RBI's measures, do you think there would be again a hardening of short-end yields happening, and we would be back into the elevated yields scenario?
We don't think so. So I would split this question into 2 parts. The demand supply for the corporate bonds and the CPCDs, and the demand supply for sovereign bonds per se. So for corporate bonds and CPCDs, what we have seen is that corporate bond generally acts as a conduit of the cheapest source of financing for the corporate sector in the country. Now, in last 1.5 years, we have seen that domestic banking system has turned out to be the cheapest source of financing for major corporates into the country, thanks to the external benchmark linked loans that banks are providing since the prominence of these kind of facilities that banks have entered into over last couple of years. So in this construct where global interest rates are elevated, which made it very, very expensive for corporates to go and borrow overseas, domestic bond markets are running ahead of RBI's and pricing in much more rate hikes, and coupled with the tight liquidity financing conditions, made your corporate bond borrowings the other source of financing with the corporate sector was an expensive source of borrowing. So the cheapest source of financing was the banking system that corporates have used very, very proactively in last couple of quarters. As a result, what we have seen is that banking system credit growth has far outstripped the deposit growth in last year or so. So much so that in the April to June quarter, the average credit growth for the banking system has stood in excess of 18% in April, May, and June, all of these 3 months put together. In fact, in June, we topped almost 19% credit growth. May was about 18.5%. April was about 17%. At the same time, because of the tight liquidity conditions and an adverse taxation on the fixed income as an asset class that we have seen over the last couple of years, we have seen that deposit growths have not been keeping pace with the credit growth. So there has been a lot of pressure at the shorter end of the curve led by banking system who were finding it difficult to finance the credit growth, and hence we were getting into a spiral where shorter end of the curve was rising because banks were raising more CDs because of the inability to raise deposits, and corporate sector going and tapping banking system more and more for the credit requirement because bond markets and overseas markets were very, very expensive routes of financing. Now, to break this chain, RBI has announced a lot of measures to attract capital flows into the country via the dollar route. So all your ECB or the FCNR deposit route, the ECB route, and the relaxation of investment for FPI investors into the domestic fixed income market. So for a couple of months, what we may see is over next 1 or 2 months will look far more attractive than what we have seen in last 1 year. And at the same time, all these PSUs going and borrowing from the overseas market will allow them to go and repay some of the borrowings from the banking system, which means that there is a potential case for banking system credit growth to come down as compared to what we have seen in last 3 to 6 months. So in this construct, we see a very favorable as far as the corporate bond is concerned. And hence, we are very, very constructive and very, very vocal about our trade idea that 1 to 3 year part of the yield curve, especially on the corporate curve, looks very, very attractive. Now, coming to the longer end of the curve, we have seen that central government's fiscal deficit has been coming off very, very substantially over the last couple of years. So after peaking out at about 9% in 2020-21, the post-COVID year, this year headline fiscal deficit target is supposed to be at 4.3% of the GDP. Now we have consolidated by almost 500 basis points over the last 5 years at a headline fiscal deficit number, which means by nature, GSEC demand has improved over the last couple of years. However, the negative factors which has come through in last 2 or 3 years has been that lot of the long-only investors, which were traditional only fixed income investors, have now been asked to allocate a large part of their portfolios into equity as an asset class. So if you were to look at insurance companies, if you were to look at the provident funds, if you were to look at pension funds, these cumulatively used to be a very large buyer of domestic fixed income instruments because that was their natural source of asset allocation. Over last couple of years, what we have seen is that in line with the compression in the headline fiscal deficit, we have seen a steady demand erosion from these long-only investors away from fixed income towards equities. So much so that last year, pension funds had to invest almost 100% of their inflows into the equity markets last year because their asset allocation pattern underwent a change from the 15% to 25% in last year. Which means that at a stock level, if you were to rebalance, there was no incremental money left with pension funds to go and deploy in these categories. We think that worst of these asset allocation changes is behind us. As and as we progress into the rest of the fiscal year and as interest rates start looking more attractive at the longer end of the curve, we will see that demand for fixed income instruments at the longer end of the curve will start improving as we see the year progress going forward. I think so. We think we are very, very constructive at the longer end of the curve as well. So 30-40 year part of the yield curve or anything beyond 10 year, 15 year, 30 year, 40 year looks very, very attractive from a fixed income perspective.
So great. Good to know that the steepness of the yield curve, is also now that you're constructive on the long end as well because of the steepness of the yield curve. And I think for our investors, you've really delved deeper into how the credit deposit ratio would improve or how the gap between the credit growth and the deposit growth would narrow down and why it would narrow down. So I think that helps us understand both the short end and the long end. One more point or a couple of more points on the long end of the yield curve. So we understand you're constructive because of the steepness of the yield curve, but and the demand side also is, I suppose, improving because of the FPI inflows. And do you also think the government borrowing shifting towards the lower maturities is also one of the reasons why it would add up to your being constructive?
Yeah, that's a very relevant point that I missed out into the demand. So while I address the demand side, on the supply side, what we have seen is that given the lack of transmission or more so of that at the longer end of the curve, we have seen that government as well as RBI has been very, very vocal about ensuring the transmission of the interest rate actions into the domestic market. In line with that, we have seen that the transmission of the rate cuts that RBI has delivered has not happened predominantly because of the demand-supply mismatch in the sovereign bond markets. Now, to address this, if we were to broadly take a look about a large part of our government borrowing program for the fiscal year 24-25, almost 35 to 40% of the government borrowing was happening in 30, 40 and 50 year maturity buckets in 2024-25. In 2025-26, they have reduced that number down to about 30 to 35%, being concerned about the elevated level at the longer end of the yield curve. Now, more and more feedback went to the market saying that the demand for the longer end of the curve, because of the demand destruction on account of shift in asset allocation patterns, we have seen that the first half of 26-27, they have further reduced the borrowing at the longer end of the curve to almost 25%, as against what they would have done 30-35% in a normal year. Our sense is that there is a very strong probability that we will end the year with 30, 40, 50 year parts of the yield curve being utilized for not more than 25 to 30% of the overall borrowing program for the current year 26-27, which means that while demand will continue to look better as compared to last year, supply would be lower as compared to what we have seen in last 2 years. So there definitely is a very strong case for investors to look at the longer end of the curve even at this point in time.
Great. So, Anupam, you have given us a lot of threads and a lot of texture, bringing our discussion together. What do you think that the yield curve would start to steepen or would steepen over the next 6 to, let's say, 12 months, with the short end moving down much more than the long end? And while that happens, what do you think about the spread of corporate bonds over the G-Sec? So if you can give us this perspective in a quick, view, then will help.
Yeah, so if you were to look at the shape of the yield curve today, your sovereign bond yield curve across the duration is very, very steep. So if you were to look at the overnight curve, or the 3-month T-bill starts at 5.25, and your 30-year, 40-year G-Sec ends at 755 or 760. So there is almost 225 basis points of steepness in the sovereign curve. Now, if we were to benchmark this to a corporate bond curve, your corporate bond curve today, the front end of the curve starts at 6.5%, and the longer end of the corporate bond curve, which is a 10-year corporate bond, ends at 740. So corporate bond curve today is relatively flat as compared to a sovereign curve, which is your the spread at the extreme short end of the curve is almost 125 basis points, whereas in the medium to longer end of the curve, the spreads are very, very narrow, which are close to 25 to 50 basis points. So we think that incrementally there is a lot of potential for corporate bond curve to steepen further. However, the absolute level on interest rates, because they are so attractive, we think that there is a potential for a steepness along with some parallel shift down in the yield curve at an absolute level as well. The beauty lies here that the extreme longer end of the curve, even if it falls in terms of a basis points, which might be much lower than the short end of the curve, the quantum of capital gains that an investor would make would be far larger because of the larger duration plays at the longer end of the curve. So just to give you a perspective, if a 1-year bank CD falls by 100 basis points, you make 1 rupee of potential capital gain. At the same time, your 40-year bond has to fall by only 10 basis points to make you your same 100 basis points of capital gains. So we think that even if the curve steepens, if there is a marginal probability of yield curve at the same time parallelly shifting lower, even by 10, 15, 25 basis points at the longer end of the curve, and which we think can happen over the next 6 to 12 months, the quantum of gain that an investor would make at the longer end of the curve will be far higher than they would make at the shorter end of the curve. So now if you were to bring in the argument of risk-adjusted returns, we would say something between 3 to 4 year or 3 to 5 year duration looks very, very attractive at this point in time. So if you can pick a point on the yield curve that you like, pick a point on volatility on interest rate that you like, pick a point on credit on the yield curve that you like, and choose a product accordingly. Thankfully, our mutual fund product basket is completely full to give you enough choices to asset allocating to whatever point of yield curve that you like at any point in time.
Great. So, from the investor's perspective, let's say if somebody was to construct incrementally a portfolio, then corporate bond fund, what percentage allocation could you give to corporate bond, which is, let's say, 3 to 4 years, and very short end and the long end percentage allocation? Can you give category wise?
So, it would be difficult to give you a one-size-fits-all approaches, but ideally, depending, I would say that, something that you need for your cash flow requirements over the next 3 to 6 months, you can choose products like money market fund, ultra short-term fund, or low duration fund, and for your liquidity as something that you can look to invest with between 1 to 2 year or 1 to 3 year. We would say you can look at product like a short-term bond fund, bank PSU, corporate bond fund, or even our medium-term fund and or a credit risk fund to take advantage of the accrual. And if you have a serious view about asset allocating to fixed income for medium to longer term, or say I would say 2 year, 3 year or beyond investment horizon, long duration fund looks very, very attractive from an asset allocation perspective.
Thank you, Anupam, for giving us a peek into, the details of the inflation growth dynamics, the liquidity piece, and the bond supply dynamics as well. And also, letting us know and explaining the expectation of the yield curve movement going ahead. Thank you. Thanks a lot. Happy investing to all our investors, and thank you for joining in.
Thank you so much, Shaily, for having us. Thank you.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.